Good morning and welcome. You are watching Market Cafe on ET Now. I'm Nupur Talwar Suri and joining me is Ankita Saxena. And together we'll be taking you through all that's making news in the US markets as well as in Asia. Well, we begin in fact with the US stock indices that have closed on Thursday higher, rebounding from the previous session's losses as chip makers rallied and investors are assessing the earnings. Now, the S&P 500 gained nearly 1.7% and the Nasdaq also jumped 3.4% and the Dow added 614 points. Microsoft surged 15.5% after reporting 43% cloud revenue growth, its strongest since 2022, while keeping capital expenditure guidance broadly in line with expectations. Now, chip makers jumped after yesterday's sell-off and Micron rose 18.4%, AMD gained 13%, Intel added 11.3%, and SanDisk has soared nearly 26% as investors have bought the dip on expectations that the AI-driven rally still has room to run. Now, Nasdaq futures edged higher as well overnight trading as Wall Street staged a sharp rebound. Nasdaq 100 futures gained 0.5% and futures on Dow Jones Industrial Average have also risen 0.2%, while S&P 500 futures have inched up as well, about 0.1%.
Absolutely, a rebound coming in all the tech names, whether it's an Apple, Microsoft, or any of these tech names that have reported its numbers. That is seeing a jump up. In fact, that is also seen in the Asian markets. Look at Kospi, that has jumped up 15%. In fact, the trading had to be halted on account of SK Hynix and Samsung surging away in trade, and on the back of that, Kospi saw a rebound of almost 15% today. And the other Asian markets also right now are in the green, except for Hang Seng that is trading with cuts of 0.5%. Shanghai is trading up 1%. Nikkei is also up 5%. S&P ASX 200 is also up 0.3%. Now, another big reason for why these markets are perked up in trade is the cooling off of oil prices. Now, Saudi Arabia has proposed to form a proposal of a naval coalition of sorts, and they said that 40 countries attended that because of the increasing attacks by Iran. In fact, Iran's, the Houthis have been attacking the naval ships, and also the fact that they had imposed a blockade for Saudi Arabia, and in Yemen they had declared a maritime embargo on Saudi Arabia last week. And on account of that, Saudi Arabia is now determined to protect the naval and the maritime. And on account of that, we do see crude oil prices cooling off as of now. We do have Brent crude that is sitting at $88 per barrel. It's well below the $90 per barrel mark. It's it's down 0.8% right now. WTI is also sitting at $82.48 per barrel. That's down 1.3% on account of that. And that is also really buoying the sentiment across the globe. Look at the implied start to Nifty. It's suggesting a start of almost 70 points on Friday morning. So that's really how the markets are shaping up.
And let's take a look at what's happening and what's really cooling off those prices. And tensions in Asia have escalated further after Iran's Revolutionary Guard vowed to punish the aggressor today following a fresh wave of US strikes. The US says it targeted dozens of military sites across Iran in retaliation for Iranian missile attacks on American forces. Tehran has also claimed that it retains full control of the Strait of Hormuz, raising fresh concerns over regional security and global energy supplies.
And the US economy slowed more than expected in the second quarter, with GDP growth easing to 1.5% below the forecast of 1.8%, while the headline number disappointed. Consumer spending and business investment remained resilient. The inflation, however, continues to complicate the Federal Reserve's outlook, with the core PCE inflation at 3.3%, well above the Fed's 2% target, reinforcing expectations that the policymakers will remain cautious on interest rates.
Amazon has delivered a strong second quarter, beating street estimates on revenue and cloud growth, while significantly raising its AI investment plans. Now, AWS revenue has surged 37%, its fastest growth since 2021, prompting the company to lift its 2026 capital expenditure guidance to $220 billion from the earlier $200 billion. CEO Andy Jassy said soaring AI demand and higher memory costs are driving the increase, adding that capacity will remain constrained through 2028.
And like we've mentioned at the start of the show, Apple has delivered a better than expected June quarter driven by strong iPhone and Mac sales. However, the stock fell in after hours trade after management issued a weaker than expected September quarter outlook. The CEO Tim Cook said that supply constraints, particularly the advanced chip manufacturing, are limiting Apple's ability to meet demand even as customer demand remains rather strong.
And Reddit has delivered another blockbuster quarter, comfortably beating street estimates on revenue, earnings and guidance. However, the stock fell about 11% in after-hours trade after management flagged volatile search referral traffic from Google. While advertising and user growth remains strong, investors are increasingly concerned about Reddit's dependence on search traffic for new users.
And Bank of Japan is widely expected to keep interest rate unchanged at 1% today, but the markets will be watching for a hawkish signal of future rate hikes. The meeting comes after Japan reportedly intervened to support the yen, which has been under pressure near multi-decade lows. Investors will closely track Governor Kazuo Uriya's comments for clues on the timing for the next rate hike.
And fresh tensions have emerged in the US-China technology battle after Beijing threatened retaliation over Washington's restrictions on imports of foreign-made humanoid robots. Now, China says the move severely damages bilateral trade ties and has urged the US to reverse the decision while warning of countermeasures if the restrictions remain in place.
And a major rift has emerged in world football after UEFA threatened to boycott FIFA competitions, including the World Cup, over FIFA's plan to sell a stake in its commercial business to private equity investors. UEFA says that football's governance cannot be driven by investor returns, while FIFA insists that the proposal is optional and aimed at accelerating the sport's global growth.
And staying with some sport news, it's a historic football clash that will be coming to India. The Blue Tigers will take on the five-time world champions Brazil on the 3rd of October at Kolkata's Salt Lake Stadium, marking the first ever senior international between the two nations and Brazil's first senior men's match on Indian soil. Now, Brazil will also be India's highest ranked opponent since the FIFA rankings were introduced in 1992. While the squads for both teams are yet to be announced, expect some big names to feature in this blockbuster friendly.
And the IMD has issued an orange alert for Palghar and Thane and a yellow alert for Mumbai as heavy rainfall continues across western India. Gujarat remains on red alert with extremely heavy rainfall expected till 2nd of August, while the overall monsoon deficit has narrowed to 14%, reflecting an improvement in seasonal rainfall. Akanksha is now joining us with the weather report.
That's right. Monsoon activity continues to remain strong across several parts of the country, with India Meteorological Department issuing fresh weather alerts. IMD has issued an orange alert for Palghar and Thane, while Mumbai remains under a yellow alert. Meanwhile, Mumbai's water reserves continue to remain healthy. As of July 30, what we are seeing is the city's 7 reservoirs hold 88.49% of their total live storage capacity. On the other side, the IMD has issued a red alert for Ahmedabad, warning of extremely heavy rainfall till 2nd August. Now, if we take a look at the forecast, heavy to extremely heavy rainfall is expected over Gujarat and Madhya Maharashtra. Heavy to very heavy rainfall is also likely across Arunachal Pradesh, East Rajasthan, Karnataka, Kerala, Konkan and Goa, Punjab, West Madhya Pradesh and Jammu and Kashmir. Now, if we take a look at the latest monsoon deficit numbers released by IMD, so as of July 30, East and Northeast India reported a 30% rainfall deficit. Northwest India is at 11% deficit, while Central India is at the lowest deficit number, which is of 1%. On the other hand, South Peninsula continued to record the highest deficit of 25%. So overall, India's cumulative monsoon rainfall deficit number has narrowed down to just 14% as of July 30.
Well, as far as Mumbai is concerned, of course, we're expecting heavy rain today, but we slip into a very short break here on Market Cafe. When we return, we bring you more news. Do stay with us on 80 Now. Welcome back. You are watching Market Cafe on 80 Now. And let's take you through all the news. Jane Street's appeal against SEBI's interim order will come up before the tribunal today. Now, the US trading firm is challenging SEBI's allegations of manipulation in India's equity derivatives market and is seeking access to documents related to the regulator's investigation. Now, Anurag Joshi is joining us with more on this. So, hi, Anurag. Give us what you are expecting today.
Trading firm Jane Street's appeal against the Securities and Exchange Board of India's interim order that was passed last year is listed on the Securities Appellate Tribunal for Friday. Jane Street's case has been listed on SAT in recent months, though the tribunal is yet to hear the matter. Now, to give you a chronology of events, on July 3 last year, SEBI passed an interim order accusing Jane Street of market manipulation in India equity derivatives. And in September, the Securities Appellate Tribunal ordered SEBI to reply in 3 weeks on the Jane Street matter. Now, this interim order is looked at 18 key days of Bank Nifty index manipulation, and the period probed for the SEBI order was on the expiry date from Jan 2023 to March 2025. The probe looked at 3 days of Nifty index manipulation on the expiry date in May 2025. Jane Street had in fact requested the release of all documents with SEBI that are relevant to the case against the firm. But the SEBI told the tribunal last year that it will not share those documents that the regulator hadn't relied on for the case to deliver the interim order.
All right, let's talk about the earnings then. Weak quarter likely for ITC with the cigarette business to be under pressure. Snehi is here with what to expect.
Well, yes, if I have to sum up the kind of expectation that we have from ITC's Q1 earnings, we're expecting to see a weak quarter. And this was largely expected because remember, all that excise duty hike that's done by the government did not play out in the previous quarter. So largely the street has factored in that the impact of that is going to be seen in this quarter because the company, yes, has hiked prices of its cigarettes, but the hike has not been in proportion with which the tax has increased. So maybe because of that, there could be a very big negative impact on the company. But here's taking you through some of those numbers to be looking out for on a standalone year-on-year basis. We're expecting the revenue to come in at 18,630 crore rupees, which is a downtick of 5.5% on a year-on-year basis. EBITDA is seen as 5,355 crore rupees, which is down 14.5%. For net profit, we're expecting this number to come in at 4,335 crore rupees, which is down almost 12% on a year-on-year basis. So yes, on the top and bottom line, we're expecting to see some major impact. On the margin front too, we're expecting to see a sharp cut of 300 bips on a year-on-year basis. We're expecting this number to come in at 28.7%. Remember, this time last year, this number was at 31.7%. So sharp 300 points shave off is what we're expecting here. Now, in terms of some segmental revenue for FMCG cigarettes, we're expecting the revenue to go up by 34% on the back of all the price hikes undertaken. FMCG others, their atta, their dairy, all of that in the other segment will go up by 11.5%. Agri revenue is expected to go down by 3.5%. Some pressure in the agri segment is expected. And paper boards this time is expected to grow by 7% on a year-on-year basis. Just talking about cigarettes in particular, for a bit, cigarettes business is expected to be heavily under pressure with 8% year-on-year fall in the volume seen of cigarette, and cigarette EBIT is expected to plunge 25% on a year-on-year basis. Of course, on the back of excise duty and price hikes not being in tandem with the excise duty hike that has been seen. So lastly, when the numbers do come out, some factors that you should be watching out for are impacts of course, the impact of the tax hike on the cigarette business, the nature of price hikes undertaken and if more are on the cards, if so, then when, cigarette volume trends, the product mix, competitive intensity, raw material pricing and the agri-business outlook. Watch out for some of these factors, but yes, all in all, we're expecting to see a weak quarter this time from ITC for Q1.
Now, Tata Steel has reported an inline set of Q1 earnings with a miss on PAT. But how have the brokerage houses been reading into these numbers? And Ashesha is joining us live now. Hi, Ashesha. So do some number crunching for us. What is it looking like?
Well, yes, so steel major Tata Steel reported largely inline set of numbers. India EBITDA per ton has seen an increase of about 21% on a quarter-on-quarter basis on account of several factors. The most important one being higher realizations in the quarter gone by on account of rise in steel prices that we saw on a sequential basis. Meanwhile, the net debt has also risen by about 5% on a quarter-on-quarter basis because of the expansion plans that the company has been undertaking, especially with respect to Neelachal Ispat. Meanwhile, we also have Goldman Sachs, which continues to maintain its neutral stance in the stock with a target price of 218. They say consolidated EBITDA grew by about 25% on a year-on-year basis, ahead of street estimates but below consensus estimates. They say India operations exceeded estimate across all divisions, but Netherlands operations reported performance that was below what the street was working with. So India resilience is one factor which continues to aid consolidated numbers for Tata Steel.
Morgan Stanley, meanwhile, has maintained its overweight stance. 235 is their target price. They say standalone EBITDA beat estimate on higher realizations in the India operations, but consolidated was below what the street was working with. Meanwhile, they've also spoken about Netherlands and UK operations, which was broadly in line. Elevated operating costs, operating expenses on account of higher coking coal prices in the quarter gone by offset higher realizations that the company enjoyed. So all in all, India operations continue to remain resilient. Consolidated numbers were largely in line. Netherlands was impacted this time around on account of plant shutdown, and Europe reported a loss this time, but we are not expecting any major reaction on the stock today.
All right, Shesha, thank you so much for joining us for Tata Steel. But let's also talk about Bajaj Finance that reported an in-line first quarter. With further asset quality improvement, management retained the FY27 guidance that indicated there could be an upgrade after the second quarter if the current growth momentum continues. My colleague Harsh is joining us with the highlights.
Well, yes, it was a largely in-line quarter. A couple of beats here, when you're looking at the numbers itself. One was the lower credit cost number, right? The other one was that as part of the commentary, the growth that has been guided for might well come in stronger than the 22 to 24% guided band that Bajaj Finance has guided for at the end of Q4 FY26. They've guided for FY27 growth to be 22 to 24%. And, that could well surprise on the upside, but we will know that, or they will up the guidance only post Q2. So that was the one thing which really stood out. The other piece is they've done around 300 crore rupees of macro provisioning already in this quarter itself. West Asia as well as weaker monsoon, they're trying to factor both of those into those provisions, even though they're not seeing anything on ground. So this is just a safety net which they've created, and despite that, the provisioning was a beat. The reported profitability was around 3 to 4% higher at 6,081 crore versus the expected number of roughly 5,800 crore. So you've clearly seen better than expected set from Bajaj Finance. Could well be in focus just given the fact that they're doing plenty on the AI front. They're expecting efficiencies to kick in. They suggested all of these things on the con call. Also, gold loan growth is something they'll focus on, which will aid the consolidated loan book, which is currently at 5.5 lakh crore. Gold loans could well be nearly 5% of that by the end of this financial year.
Right, so Harsh, all in all, Bajaj Finance looking quite good this morning. Thank you very much for joining us on that one. But let's go back to Ashesha now. And Swiggy has reported a mixed first quarter with consolidated revenue rising nearly 7% sequentially, while losses narrowed modestly. Now, brokerages remain constructive, but say sustained improvement in growth and profitability will be key. And coming back to you, Ashesha, on that one. So give us a sense of what the brokerage verdict is so far.
Well, yes, so Swiggy has reported good top-line growth this time around. We have EBITDA and profits that have missed street estimates, but this is on account of food delivery margin miss that we saw in the quarter gone by. But the management has maintained its guidance for food delivery margins going forward. Quick commerce contribution margins, meanwhile, have also improved by 165 basis points on a quarter-on-quarter basis. Let's put the spotlight on what brokerage houses have to say, and let's start with Morgan Stanley. They've maintained their equal-weight stance on the stock, and 322 is their target price on Swiggy. They say adjusted revenue grew YOY but missed street estimates. Adjusted EBITDA loss was wider than what the street was working with. Food delivery adjusted EBITDA beat estimates. Shareholder approval, which is expected for the company to become an Indian origin company, is expected in the middle of August for transition to an inventory-led quick commerce model. So that will be one big trigger to watch out for over the next couple of days for Swiggy. Meanwhile, Citi has maintained its buy stance, but they've gone ahead and lowered their target price. From 415 rupees per share earlier, Citi's revised target price on Swiggy now stands at 390. They say Swiggy's first quarter GOV and adjusted EBITDA were both lower than what the street was working with and their own estimates. And Swiggy's month-on-month growth in July was commendable, but the sustainability of this kind of growth in the coming quarters will be the key to watch out for. So brokerage houses continue to remain constructive. Citi, in fact, has gone ahead and lowered its target price. The management, however, has maintained its food delivery margin guidance for the next few quarters.
All right, so that's the view coming in on Swiggy, but let's also talk about Aarti Industries that reported a strong first quarter with revenue rising 42% and the profit more than tripling, aided by favorable product mix, low-cost inventory gains and forex benefits. Meryl is now joining us with the highlights.
Right. So if we first take a look at Aarti, the numbers that Aarti Industries has put out, then we'll see that revenue has jumped up to 42% on a year-on-year basis. Margins also seen an expansion. EBITDA has gone up by 12%. And profit, that's the key highlight over here, that has more than doubled this time around. Now we've seen a year-on-year growth in revenues, which was driven by higher raw material prices, which the company has then passed on to customers. And then EBITDA and operating profitability has especially been supported by, first of all, better product mix on their front. There's also low-cost inventory monetization that has taken place, and also some minuscule FX gains, which have also helped the company boost its profitability this time around. On a year-on-year basis, if you look at it, then volumes have recovered, but there was a sequential impact due to the West Asia-related conflict and supply chains issues thereafter. But the management has guided for volumes to recover starting from the second half onwards, especially as supply chains start to normalize. West Asia, as a business geography for the company, the contribution coming from West Asia has fallen down to 2% from earlier 15%. So that has certainly created an impact. But looking at the overall health of the business, they remain on track to deliver 700 to 800 capex for the full year FY27. And they've also got a bunch of very interesting strategic projects to watch out for. These include a Superform JV, which is on track to commercialization starting from the second quarter itself. So the outlook on Aarti Industries does look healthy. It has seen a quarter-on-quarter impact on revenues due to the West Asia crisis, but costs are being passed on to customers. So an overall positive when it comes to Aarti Industries.
All right, Meryl, thank you for that one. Now, it was a good quarter earning for M&M, with PAT revenue meeting street estimates, and brokerages are very bullish on M&M, with Novama, NK and MOSL maintaining a buy. In fact, Avi joins us with more on this. So hi, Avi. Tell us what these brokerages are actually penciling in.
So M&M has come out with its Q1 FY27 numbers, and the numbers are good since all the numbers are in line with our estimates, with revenue coming in at 41,920. But the only concern seems to be the EBITDA margin, which is something that all the brokerages have highlighted also, since the margins have contracted at 12.2% versus 14.3% last year for the same period. Talking about the market share, now 1 out of every 4 SUV is a Mahindra SUV, since the market share has now reached 25%. Talking about the capacity expansion, currently stands at around 64.5k units per month, which they will expand to 82k units per month by the end of FY27, and by the end of FY31 this capacity will have been doubled. So a good capacity expansion by M&M there, with brokerages like Novama giving it a buy rating and a target price of 3,900 rupees. They believe that the robust growth aspects in auto segment and farm to be modest in the FY26 to FY28, with revenue to grow at a CAGR of 16%, and recently launched XUV 7XO and XCV 9S has evoked a strong customer response, and which is the reason they have given it a target price of 3,900, wherein Novama has given it a target price of 4,100, as it believes that the launch of NU IQ platform and the commodity inflation impact that will be offset by price hikes that M&M will take in the upcoming quarters will help sustain the margins, and that is the reason for the 4,100 target price by Novama on M&M. Talking about a few of their con call KTAs, they've mentioned that the commodity headwind for Q1 was in the range of 4 to 5%, and price hikes will then help the company to offset this margin pressure. They're also telling that the auto demand has been good in both rural and urban areas, with 15 days of dealer inventory, and the farm outlook is supposed to be estimated to be weak in the Q2 volumes because of the festive season and lower volumes to weigh on margins as well for the farm segment. So all in all, a good set of numbers from M&M, with brokerages like Novama giving it a target price of 4,100.
Right, Avi. Now, do stay with us. In fact, we'll go across now to another auto major. It was a steady quarter of earnings for Hyundai India, though it has declined on a YOY basis. Continued geopolitical headwinds have seemed to be dragging sales volumes. So, Avi, tell us more about that one.
So when we see the Hyundai Motor India results, if we compare it on a yearly basis, the results are really bad, as the EBITDA and PAT has fallen in the range of 30 to 35%. But when we compare it with the estimates, the results are actually good, since the margins are a 30 bips beat on what the estimate was, while the PAT is a beat of 8%, and that is the reason the stock was up around 2%. Talking about some brokerages, we can see that Novama has given it a buy rating with a target price of 2,500. It believes that the robust launch pipeline, along with the R&D capabilities of its parent company will help company reach new heights. And Centrum has also given it a neutral rating with a target price of 2,100 coming in. It believes that the EBITDA margins, the ROC, ROE, all metrics have been on a superior performance compared to its peers historically, and Hyundai Motor India will catch up very soon, and that is the reason the brokerages like Nuvama has given it a target price of 2,500, with Centrum giving it a neutral rating with a target price of 2,100.
All right, thank you so much for that, Avi. Do watch out for Hyundai India as well in today's trading session. But with that, we have to wrap up this edition of Market Cafe. Nupur and I will take your leave. Thank you so much for tuning in. Don't go anywhere. The market is coming up next.